Welcome. I'm going to do a weekly review. We're going to look through the week here today, and we're going to look through all the trades I took this week. So I did take great trades, although there were better trades available, and a few of them broke my rules. While being winners, they still broke my rules. One loser broke my rules. And while many of them were good trades, there were just better trades that more accurately followed my rules, okay, that followed my system. And that's important. It's important to look at the winners that weren't the highest quality and then try and remove those and replace them with better, higher quality trades that follow your system. Okay, I've been trading very counter trend lately, counter to my bias. Even though my bias is bullish, I've been trading short, and while my short trades have been effective, I've been taking base hits and I've been following my counter trend rules, which are base hits, 1Rs, maybe 2Rs, but basically taking profit at first resistance. There were just better trades available. Now, looking at this week, what do we see? We came into this week with a very bearish Friday that left insane amounts of fear in the market. I got some ICT open. I barely watch ICT anymore, but regardless. Anyways, let's see here what we're gonna do here. Fear, greed, or CNN. Fear. Extreme fear on the previous close, so we were at literally extreme fear near all-time highs. Generally what that means is we're going higher. Now, without getting too much into macroeconomics, anytime there's a dip for at least the next 6 to 12 months, I will be buying the dip. It's just extremely clear that any dips and any emotional frenzies that occur in the market should be to the downside, should be purchased. It's pretty clear. And maybe we do get 2 or 3 months of bearish price action, although I doubt it. Still an opportunity to just average in, because ultimately we are in a very euphoric bull market. Okay, so with that being said, I kind of come into every single week with that bias in mind, and that's my anchor. I look for reasons to be bullish. I look for reasons for bears to basically be capitulating. And this low, I came in with the expectation that we would be rallying up on the Sunday, and we did have that. We gapped up very aggressively. We rallied up in the Sunday, and because we rallied up in the Sunday, I don't have a very bullish Monday idea, right? We've already created the bullish move on Friday, and then Monday I'm expecting it to just kind of be indecisive as traders attempt to get short and higher up in this market, and the bulls also attempt to buy that absorption following this euphoric bullish move. The perma bulls, which generally most people are, they attempt to buy long, and that's going to generate lots of liquidity. So I marked out Monday's low and Monday's high, and this is our liquidity that's available, right? Because this is our range here and here. When we have a large range like this, we're not going to look for that liquidity at the highs and lows. When we have a large imbalanced range like this, we look for new range or new structure to form internally inside of that range to give us new biases. So until price develops new structure, there's really no reason to have a bias. We simply wait. Tuesday comes around, push down lower, tapping into that volume imbalance, which also happens to be a true liquidity void here where there's no wick or no bodies. And then we reject pretty hard off of that. Go bullish. Tuesday's high here. Tuesday's high gets taken out on Wednesday. Monday's high gets taken out on Wednesday. Then it rejects, comes down to take out the significant low on Tuesday, and then continues back into the range. This is Asian range. When we have a nice consolidation like this, it's easy to measure out the standard deviations, 1 standard deviation, 2 standard deviations, up to 3 standard deviations. That second standard deviation paired with buy side liquidity, and that gave me a very clear target of buy side liquidity in order to draw to. After that draw occurred, we had a manipulation intraday and then displaced back down lower, taking out Wednesday's low. And then again, consolidation, measured out Asian range, 2 standard deviations, pushed back down into the volume imbalance, and Friday took Tuesday's low and then reversed higher and higher. This is a very typical seek and destroy profile, which commonly is touted as something you shouldn't trade, but with my structure map, it becomes relatively easy to trade. You follow swing points predominantly as your bias, and you use ISPs as significant points of liquidity to be taken, and obviously new ranges to be trading in. And we'll see that when we get into the intraday. But what's even more important is that I have a structure map here that shows this kind of price action where we have an impulsive selling pressure, a generation of liquidity on the internal side of this range. New high, we take highs, and in the process we're generating liquidity, and then we sweep that liquidity down, create a new swing point, break up, create an ISP, and we're looking to see this high taken. If this high is taken, then we're confirmed extremely bullish in the process of creating a new higher time frame leg that will send us into all-time highs again. And then you of course have targets to look for in the event that that does occur. When we see this type of price action, what we do is we look for the highest high and the lowest low that's developed in this range. So not this high, but we're bullish, right? So we're not going to measure this high to this low and then get bearish projection. Instead, we're going to look for the lowest low that's been caught, and then the highest high of this range, and we're going to measure that. So I've grabbed the highest high, I've grabbed the highest low, push that to the side here, and then within this range, I've measured OTE. OTE happens to be in line with that volume imbalance. It happens to be in line with liquidity. It happens to be in line with the projection of standard deviations of the Asian range. And then we push higher. Now, that in and of itself is not necessarily enough to be buying. Also, there was an incredible buying opportunity that I was looking for in here, and one of our traders caught that. Kudos to you. You know who you are. And instead, I was looking for reasons to buy higher. I actually think I might have taken a short on this day, but that's besides the point. Okay, so now we can go to the 15-minute, and we can look at these intraday moves, okay, and what's occurred during the kill zone. So what I've done is I've marked out each kill zone here. You have London and New York, which was consolidation on Monday. London pushed us down lower, generated liquidity here, and then New York manipulated and reversed, gave us a very clear entry off the reversal, change in state of delivery, moved higher. London consolidation, New York manipulation at the highs, reversed and displaced, right? Accumulation, manipulation, distribution, accumulation, manipulation, distribution, AMD. London, accumulation, manipulation, distribution. And then London, we had accumulation over Asian session, manipulation over London, and distribution continuation over New York. I notice we did not take those lows. It was just pure distribution higher as we absorb short sellers with buying pressure and go higher. Very, very interesting stuff. Very cool, very cool. So how could we have looked for trades here? Well, again, we're focusing on that liquidity. We're focusing on the external areas of these new ranges that are being developed, ignoring this, but using this as the bias of our ultimate draw on liquidity, our next likely draw on liquidity, right? So anytime we do sweep those lows, we're favoring a take of buy side liquidity. As long as they're in session, we can see that, right? Besides Monday, New York distributed, New York manipulated and distributed, New York manipulated and distributed, New York distributed towards liquidity, towards liquidity, towards liquidity, towards liquidity, and then towards liquidity. Very interesting stuff. Very, very cool. Very cool. Now, finally, let's go through my trades. Again, obviously, I'm expecting that we make it higher. There's no reason not to be expecting that we make it higher. And with gold likely to be in a severe higher time frame retrace, let's just talk about that very quickly. large bearish candle in the higher time frame, it is not unlikely to see a lower low from here and see the NASDAQ rally. Okay, doesn't need to happen, but oftentimes when gold does go through these pause periods, we might see NASDAQ rally. October 8th into October 9th. Let's go to a daily chart. October 8th to October 9th. Let's see this area here. From April 22nd all the way over to August of 20th. We saw insane levels of rally. And then when, as you can see, when gold started to break out, this rally became a lot more choppy. Still a grind to the upside, but overall you can see comparatively to before is we started to have a sideways period. And I think that's, again, what is occurring before we go significantly higher. But now I'm getting off track. So let's go back to our chart here. Where did we go? There we are. Now let's review all of my trades. So Monday, a lot of this was base hits all week. This is a very good low effort, high probability trading style that you can use, which is using pre-market liquidity highs and lows at 9:30 open. So we took out London low, created pre-market liquidity with low resistance on this side. We created pre-market liquidity highs right here. 9:30 hits. Let's slap that on here. Show current week sessions. Let's get 9:30 on there. Equities. Sure, why it's not working. There we go. So as we can see, here's 9:30. 9:30 opens up. We push up into an OB, break down, take liquidity, fail to take the low, push up higher, create an FEG. I took a trade on that FEG covering the low. I should have targeted this high, but instead what I did was I just targeted the basically the 9:30 high, the opening high, just as low hanging fruit, something like that, and took a 1-to-1. But what you can do is wait for market open, weigh out your pre-market liquidity points. You can trade to one and then assume that the other will be traded to, or you'll just trade to the one, which is generally what my trades have been looking like. The next day, same thing. What did we see here on Tuesday was 9:30 took place, pre-market lows down here. Even this is kind of like your low-hanging fruit pre-market lows. 9:30 opens. We trade down to those. We trade down through all of these lows. We come back down into that volume imbalance, reject off of it, come up higher, create a gap, reject off that, create an SMB or a smart money break, FEG, and here I'm looking for reasons to go long that are very clear to me to take out those pre-market highs. As we're creating higher ISPs, when a swing point is created, we expect to create continuously higher ISPs. This becomes your breakaway gap because we displace through the break and then create a new FEG that's respected. We create a new range here. Reject, break up higher, create a gap with an order block taking that trade up higher for 1R, just taking it to the pre-market liquidity. Why? Because this week I do have a higher time frame bias, but I don't know, how high we're going to go. We're just taking liquidity and reversing. So I'm following the momentum of trades into low-hanging fruit liquidity points. And then at the end of the day, we start to trade sideways. Right in here, we come up deep into premium, into the type 1 range, we go sideways, then we displaced near the end of the day, and again, just following that liquidity here, following the momentum. Nothing really crazy. These are just momentum plays that are base hits. This is nothing really tough about these trades or anything fancy, but we displace lower, create an FEG, another smaller FEG here, break down lower, another FEG, break down lower, another FEG here, paired on with the old low, and then again taking that trade 1R base hit to 2R. And going to the next week, another opening range trade, pre-market lows, pre-market highs up here. I saw we took those highs at 9 o'clock and we started to go bearish. I saw 9:30 displace, giving us a failed ISP. This is a 5-minute gap. That 5-minute gap should have brought us higher, but instead we displaced through it. And then what I did was I measured the range high to range low. And then I found the 50% of the range as my premium, and I just wanted to simply sell at the premium and then buy at the lows, the pre-market lows. So you can see I gave myself a pretty wide stop here above 930, because if my bias is correct, then 930 should be targeting those pre-market lows before doing whatever it wants to do, right? Could go higher, could go lower. I just want to take the base hits, 1.5R. And then we swept those lows, broke up higher, and there was some pretty fantastic trades on the buy side here to target those highs, but I did not take those. It was 1.5R, but this is arguably a better trade if I'm being honest. Now moving on to the next trade. After those highs were taken, price distributed down lower to take out the Tuesday significant lows here. After those significant lows were taken, again, looking at this as just taking liquidity and building liquidity, we took those liquidity, immediately reversed. I'm demanding to see price shows me reason to go long, not simply going to buy every single move right away, but I'm taking the base hits. I'm waiting for new trends to develop within the session. What occurs here, we take that low, draw on liquidity. We look for a significant area in which we can trade to. So I'm not going to measure this range, but I wanted to demand that price gives me more. So we create an ISP here. And then after an ISP breaks up and confirms this ISP, we expect higher and higher ISPs, but because your SMB point is up here, I'm looking for a failed ISP. So the reason that there's a failed ISP that occurs here rather than this one here is because we came into a range that is significant and high probability for lower prices. This was the FEG that was above equilibrium in premium, and we saw clear body reactions break down, and then that level failed with displacement. That gives us a failed ISP. When we get the failed ISP, I'm looking to measure that range and then get new targets, and that's what I did. Those targets were also paired on with this significant imbalance. And then after we displaced higher, I needed to wait for proper risk parameters. So my ISP is down here to here. It's the 1R, but I was like, that's a big stop. Let's see if this range can tighten up and give us new tradable ranges. rejected with the bodies off that level, off the consequent encroachment, breaks up, creates a new gap, taps into it, breaks up, creates a new gap, doesn't tap into it, breaks up, closes above the body of that candle, giving me a bullish order block. I took that trade up into that low hanging fruit objective, which was the 2 standard deviations, and that's pro trend with the move. Again, another base hit for 2R. And then over here, this is a very interesting trade. This trade here, I again tried to go for pre-market lows to pre-market highs. At 9:30 opened, I took a trade. I was targeting this high here. Why this high? If you measure the Asian range, 2 standard deviations that was paired on with this high, that was my target. And I was ultimately right of that being the target, but before we took the pre-market lows, but instead I got swept out. So there's a lesson here though. When we're in consolidation, we want to be focusing on swing points rather than ISPs, and this is very clear consolidation. If I go on a higher time frame, this is very clearly a consolidation range. So we should have focused on, I should have focused on the swing points. Had I focused on the swing points, I could have had my stop down here and my target up there and taken a 1R instead of a -1 and been happy with it. Would have been a great trade. But the other thing was that maybe I should have went BE after the pre-market highs were taken. And that also would be true. Now, I did have a higher target and I got that higher target correct, but the pre-market highs was really the basis of this trade, and I should have taken profit at the pre-market highs for, you know, a 1R there, or just managed to BE. But I think the ultimate move here would have been to just cover the low and target the high, and followed my system, which states that when in consolidation, look for favor swing points over ISPs, because they're actually your guidance. After the lows were taken, price breaks up, creates a type 1 range, type 1 ISP range, and then comes down into it. Along there would have been good to take these highs. Price breaks up from this high, manipulates, breaks down. This is your turtle soup. So we break through the highs, push down, and then all of the breakout traders that are introduced here as this high is taken is sold into, and then price reverses, breaks down, gives an IFEG, and breaks down further. And what I've done here was I measured the manipulation. So the high that was taken, breakout traders are introduced to the top of the move, and that you can split into quarters. And what I want to see is that if we are to go lower, I don't want to see us come above the halfway point of that. I want to see willingness to go lower. And you can see as soon as we came back into the discount and broke through that range, creating that type 1 or that change in state of delivery, we again pushed down lower, and then reacted off that type 1 and the bottom of that manipulation range. It's really just a retest of liquidity, right? And that's very typical stuff. But just because it's a larger one, I like to split it up into 4 quadrants. And then we break down, come back up, volume imbalance here. We trade up into that reject entry here. This one was on a combine, and then I just targeted the low. Now, of course, looking at this, and had I noticed that there was a higher time frame SMT with the S&P 500, I would have definitely been looking to take higher prices or to scale into this trade, but I didn't, and it was on combine. It's not a big deal. Going to the next trade. Well, let me go back there. It's not a big deal. No, it's something that I can do better next time. Let's put it that way. It's very important that I take note of these things more carefully, and I take the trades that warrant being held, that are pro direction. I should be holding these trades. It's just clear as day. I should be holding trades like that. And then on Friday, price trades down, creates this Asian range to the standard deviations of the Asian range. London manipulates down lower, reverses, and then pre-market, there was an incredible trade in pre-market right here. which goes bullish. And as soon as I woke up, I was like, this thing looks like it's going to pop. I mean, everything in here was paired up very well. We had lows taken, but they stopped dead in their tracks. Displacement moved higher, and we showed clear reason to go higher. Another small displacement, tapped into the FEG. Even a trade like this would have been absolutely stellar, covering the low and just holding this for the rest of the day. Would have been something incredible. But I missed that move. Very early in the day, price displaces higher, consolidates, pushes up into pre-market, into that 5-minute FEG that I split up. It's a very large sell-side imbalance, buy-side inefficiency. And so I marked that up. And I followed followed price and ISPs in this consolidation. What I did was I followed swing points. Like I said earlier, what I should be doing is what I did. And I kind of followed the same rules of just trying to target the low-hanging fruit. Now I thought there was a possibility that we do go lower from here. So I was like, okay, if we are going to go lower, we're going to try and we're going to take out the low-hanging fruit, and then we're going to take out the previous hour's low. And what I did here was, as we see price working through this quadrant, we take the highs, we reject pretty hard. We break through this gap here, trade up higher, lower, and then we sweep this high here as liquidity, and we go for a full rebalance. And this, I took a trade here covering that swing high. Now, this was a little bit jumpy, if I'm being honest, and I should not have taken that trade. There was no confirmations here of going lower. It was very jumpy, and maybe it was like a 50-50 trade, maybe even less. And I think that, you know, if I take that trade all the time, that I'll end up burning myself and causing myself to go full tilt. If a trade like that blasts off in the other direction, it's just a bad trade altogether. Now this trade here, though, when we push down, push back up, rejects off the top of this FEG. Now the reason is because there's a volume imbalance and an FEG here, so you're going to cover both. We push up, break down. That's your confirmation of this being an ISP, which confirms this swing point and this swing point, the full rebalance. This makes a lot more sense of a trade to take this covering the ISP high, and then taking that down into the previous hour low and the low hanging fruit low, which was already taken. That was a much better trade. And in fact, even that one though, because we're in consolidation, I probably should have taken this trade just covering the ISP. But I did have a more so of a bias of possibly going down lower and maybe retesting some of these areas, like over here and here, just retesting this whole range in here, which of course did not happen, and we instead went bullish. But there was a better trade to be taken in here as well. We manipulated, broke up. Most of this kill zone was relatively low quality. Actually, I think I pretty much caught the best trade that there was in the day, other than the pre-market one. So I could have executed this better. Although I made profit, I could have executed much better. And if I do repeat that, it's playing a dangerous game. So I need to be better at taking those consolidation trades, following my system, which is to cover the ISP low and just be one and done with it. Now my management was very good, where I did not greed. I took profit where I was supposed to take profit, which was at first resistance. As you can see with this trade, I took it at first resistance, and then this scale in, I took at first resistance. So yeah, overall it was still mostly good trades. Yeah, no complaints, but I can do better next week. It's the truth. We're taking better, safer, higher quality trades. Because if I do take trades like this, not the second one was good. The first one, actually the second one should have been covering the high. If I take trades like these ones, or I take trades like this one, it's 3 trades, 2 winners, 1 loss, but those trades were risky. and they will result over time in potentially tilt, because if I take a short here and this runs and it gives me clear price action, that can turn me on, that can put me on tilt. Or if a trade like this sweeps me out and then runs to my target because I didn't cover the ISP or the swing point high, that can put me on tilt. And that's what happened over here. And this is why I took a combine trade after, is because I locked out after this occurred, where it took me out and ran to my target, and that is super tilt inducing. So I just called it a day. And had I just covered the low, I would have been up 1R, and I would have been up 2R here, and possibly even taken this trade down lower, because I would have been in a good mindset. So lesson of the day is be patient and execute with the goal of protecting mental capital in mind. Now, with that being said, we're likely to go higher into here, so that's coming into next week. Peace out, guys.